I've been trying to code some fintech since junior year. So, what's going on, guys? Welcome back to Hey Fortune. This week, or the last 2 weeks, have been messy. Didn't run the software much. Life hits hard. Algo's acting weird. I had a interview, and the partner tells me is hesitant to hire me because I'm too entrepreneurial, which I'm choosing to take that as a compliment. So let's just get right into it. All right. The main issue right now is that the holdings display, the software doesn't match to like the actual allocations that it should be. So for context, I have the software that I like use the back testing on, and then I have another software that is doing the actual live testing in that they don't line up with how they should be running. Yes, you could argue that back testing makes it different in execution, but in theory, it should be the same, or how I would like to process it. It should be the same. So I know it's stupid, but I want this to be running on a Raspberry Pi or at least in the cloud because I spent $200 on a Raspberry Pi, and so I want to use it. So it's not cosmetic. That's it's structural. So in terms of like the allocations needing to be correct, but if your portfolio dashboard says one thing and actual exposure is another, you don't have a strategy. You're just a guessing machine, and that's what I'm trying to correct. So here's the thing: I'm down 12%, and the allocation logic, I should be down like 2% because the market's like about the same for how it is. I think year to date for the market's like maybe 0.02% positive. Like there's no growth so far, and it's February 15th as I'm recording. So it's not market risk, it's execution risk when I'm down that much. So that means something is breaking down between the signal generation, order execution, portion sizing, data input, or output reconciliation. uh, these pipes are leaking and the alpha is no longer existent. So until I know which one it is, I can't trust the Sharpe ratio, the down draw, or back test. I really just have to fix it for right now. And then I'm going to record a video on the Sharpe ratio later because I keep talking about it and I just want to make a video on it for myself, but also like for whoever watches this. Like, I don't even know who watches this outside of my boy Joe. So here's the upside. This is exactly what building feels like. Everyone wants to talk about alpha and money, but nobody wants to talk about debugging. You don't build a quant system once, like you build it, break it, patch it, stress it, rebuild it. And right now the issues are the Sharpe ratio instability, automation not fully 24/7, systems not truly live, it's more semi-manual, maintenance overhead, could be too high in terms of my labor and like my mental bandwidth when dealing with school. Possible bad data feeds, potential order execution slippage, and the mismatches. It's ridiculous. If your system isn't airtight operationally, performance metrics are fiction. And I don't want fiction. I want, the real deal. So Sharpe is simple theory, return minus risk-free rate divided by standard deviation. But here's the thing that people miss. Sharpe assumes clean data, assumes proper execution, assumes correct volatility measurements, assumes that you're measuring actual returns, not theoretical ones. So if execution's off, Sharpe is meaningless. So before optimizing Sharpe, I got to focus on verifying trade logs, match portfolio values, which I hope is easy. Confirming position sizing logic is consistent, which I'm pretty sure it is based off what I've seen already. Auditing data feed, making sure that's all together, and ensuring that live performance matches the simulated performance, which that's going to be the main focus for when I revise this after midterms. So optimization comes after stability. So I'm not going to optimize without, proper verification. So let's go back to what I talked about earlier. So here's the funny part. I had the most important interview of my recent life within like the last 2 years, I'd say. It's the most important one. I met with this company back in October, like did the whole dance and like talked to them. Uh, didn't hear back until like last week. And this was the most serious interview, you know? I was in a room with like five uh, owners of the company, and the name partner said he was concerned to hire me because I'm too entrepreneurial, that I might work for them for a bit and then quit and start something else. Translation: I think you're dangerous. So good. Yeah. If someone's worried about you building something bigger, that's not an insult, it's a signal. So yeah, someone please hire me so I can get $1 million in my account faster. I'm only half joking, like Mr. Beast, like give me a few mil or something, let's get this going. But here's the truth: capital compounds faster when you have income. System scale faster when you have a runway. This is like the runway idea comes from entrepreneurship with like the burn rate and seeing how much capital you have before you like go in debt. So being entrepreneurial doesn't mean unstable. It means you think long term. So how do I build something like big one day? That means you got to hire someone ambitious. And there's the whole thing about being ambitious and being overextended, and that's something me and my mentors have been working on and trying to get me to really focus on that tunnel vision and really trying to do something one thing at a time. My buddies and I who work on these projects, we always come together and we say this every single time so that we focus on one thing until we get it done and working. So let's call it what it is. Being a JD MBA, trying to be a quant, is definitely not the traditional path, but that's fine. Law school, teaches structure. Business teaches capital allocation. Quant teaches probability. You put all that together and you get someone who understands regulation, risk, structure, incentives, and math. The challenge isn't intelligence, it's integration. So, what's going to happen next? I'm really going to be focusing on my midterms, because that's the most important part. But outside of that, I'm going to try to do a system audit, the execution, uh, get 24/7 automation, reduce manual intervention to near zero once I find that stuff. Because if it requires babysitting, it's not scalable. And if it's not scalable, it's not freedom. And yeah, I got to give an update to my, contracts professor because he's invested into this because he thinks this is cool. Shout out to my brother. He's on a mission trip in Latin America. I'm so proud of him. He's out there, representing faith, serving people, and being the hands and feet of Christ. It's a different battlefield, same mission, building something bigger than yourself. So, this is episode 3. It's not polished, it's not perfect, but real, it's real talk. Algorithms break down, interviews get interesting, the Sharpe lies, capital fluctuates, but we build anyway because fortune doesn't go to the cautious. It goes to the disciplined. So I see you next week or the week after, determine if I'm alive after midterms. Well, thank you for watching and have a good one.